Okay, so as I say, the webinar is being recorded. I'll just push the record button. Okay, so let's get started. Yeah, so those of you that don't know me, I've got the webcam on so you can see me. But I'm also getting some problems with connections here. So yeah, that's what I look like. My name is Sean van den Berg, Head of Client Education here at PSG Wealth. Welcome. Okay, looks like most people are logged in. Okay, so yeah, that's what I look like. So I'm going to switch off the webcam, so just to save on the bandwidth. But you can hear my voice and still see the presentation. Okay, awesome. Okay, nice to see the video picture. All new. This is all new. Okay, Stephen. Yeah, it's all new. As I say, I have to switch the webcam off because of the bandwidth and things like that. Okay, so let's get into it. In this webinar, we'll be discussing reading Japanese candlestick charts. Okay, those of you that do know me, that my background is such, I'm a technical analyst and I love charts, especially Japanese candlesticks. But to be honest with you, I'm still learning about it myself. After all these years, I'm still learning about candlesticks, but I have a passion for them. So anyone from the first-time technical analyst to the professional can easily interpret candlestick charts. Okay, so some of you might be thinking, wow, that's easy to say, they look very complicated. But just understand that the same data required to do a bar chart, in other words, the high, low, open, and the close, is used for candlestick chart. Okay, by show of hands, there's on your webinar, on the left-hand navigator, there's a little facility where you guys can raise your hands. This is a show of hands. How many of you on this webinar actually use candlestick charts? Raise your hands. No? No one's raising their hands. Let me see what's happening here. You should be able to raise your hands. Oh, you guys should be able to raise your hands. Okay, Brian, thanks a lot. Great. So you guys have found a facility there. Okay. So it doesn't look like everybody can raise their hands. Okay. So not everybody maybe hasn't got all the okay, thanks. Anyway, thanks for participating there. But the idea here with candlesticks, and the problem for a lot of people is that traders often mistakenly believe that the candlestick patterns themselves drive the markets. So that's the first problem. The most important thing for you to know that you can't just treat candlesticks as a magic trading tool. Remember, it is a tool, but it's not the magic trading tool. Only when the trader knows how to read the candlesticks, and we'll talk a lot more about psychology, and that's why I think the big benefit comes in. You'll be able to understand what the patterns are telling you, and obviously about the underlying market dynamics, but also the behavior of the other traders. So candlesticks, the way I look at it, is just a way of visualizing price movements. And I think this quote here, I can't remember where I got it from, says trading is all about mass psychology and candlesticks are the manifestation of crowd behavior. So that is, in a sense, the gist of my presentation today. Okay, so if I get into it, the idea here, and I say that when I say it's the gist of the presentation, if you can follow the path of the price, and that's going back to, let me just go back to my previous, this little subtitle here, nothing on the chart matters more than price. Everything else is secondary. Here's a trader, if you can follow the path of the price, you'll know how to interpret the full process of other financial players. And the main thing is you can take advantage of this knowledge and use this price action to your benefit. But it's understanding that psychology. Okay, so you can see a lot of this presentation, the content I've got from a website called Tradeicity, so you can click on that little link there and it'll explain in more detail what it's all about. So what is the current position, the current situation for a lot of people? A lot of traders, let's talk, say novice traders, they use the four basic, or mainly the two basic chart types. And it all depends obviously on the information that you're looking for. That's number one. And number two, obviously, the individual skill levels. So the basic chart types are the line chart or the closing line chart, and number two, the bar chart. And some of you are a bit more advanced traders might be looking at what they call, we'll be discussing today, the candlestick charts. And my very first charts I ever got started learning about was pointing figure charts. I call them noughts and crosses. But as I mentioned right in the beginning, the data used to create the charts is the same. The way the data is plotted, number one, and number two, how it's shown in the charts is all different. So this is a quick introduction. This is what I call a line chart. By the way, this is a graph from Metastock. I use Metastock charts. What's nice about it is you can customize the line charts and things like that. But what you're looking at here is a chart of PSG, and I'm only showing the last few months as such. So line charts basically are the most basic of all the 4 line charts because it only represents the closing price over a set period of time. You can see here since the beginning of the year. So this is only showing you a short period of time. So the line is formed by connecting the closing prices over the time frame, over a time frame. As you saw now, this is the x-axis is the time, and the y-axis will be referring to price. Line charts, however, do not provide visual information of the trading range, the high and low, in other words, okay, for the individual price, and as well, it doesn't show you the opening price. So, but the closing prices, and I use these charts a lot. Why? Because it's considered one of the most important, in the sense, remember I said right in the beginning, it's the most important when it comes to price. Okay, and that's why the price relative to the high-low, the closing price is important. And that's why we use line charts. Okay, one step further, look at the bar charts. Now, bar charts expands obviously on the line chart. It adds other several key important bits of information, namely obviously the high and low. So that's shown as a vertical line, and that's why we call it a bar. Okay, a vertical line or a bar chart represents each data point, but also shows you the range or the volatility for that particular trading period. And this year we're looking at a daily chart. So it still applies to a weekly chart, monthly chart, quarterly charts, and all charts, you name it. What's important is the closing price, or the opening price and the closing price are shown as little horizontal ticks or dashes, okay, from that bar. Okay, the opening price obviously to the left and the closing price to the right. If the closing price, for example, is higher than the opening price, you see it on Metastock charts, you can customize it. I've called all my up days blue, and when it is a down day, when the close is higher than the open, I've colored them red. Okay, so that's just a very quick way of visually seeing what's happening on the charts. Okay, so that is the current position for a lot of traders. Those are the 2 charts most people use. And then I'm not going to go into too much detail. Yeah, this is noughts and crosses or point and figure charts. Been around also for many, many years, about 400 years. It's one-dimensional. That refers to time. Yes, I've got the x-axis here, but you'll be looking at this. You can see there's no reference to real time here. But there's a lot more chart patterns involved there. I have done webinars on this in the past. I'm not going to go into it right now. The focus today is on candlesticks. So what's the ideal situation? The ideal situation for us as traders is, obviously, as I mentioned right in the beginning, you want to be able to improve your trading by learning the art of reading candlestick charts. So candlestick charts show you a combination of the open, high, low, and close data in the format, and this is where it's important. It easily shows the up and down days at a glance. Okay, so and you'll see on the next slide when I talk about a tug of war. Just understand, when we talk about the market, there are 2 groups of people in the stock market. There are buyers and there are sellers. Okay, we, as our job as technical analysts and as traders, we want to find out which of these groups is in control of the action price right now. Okay, and we use candlesticks to figure that out. So here's an example of what Japanese candlesticks looks like. Again, I'm using the same data, same period, there's the same PSG, but obviously using what I say, the candlesticks. So in the stock market, for every buyer there's a seller, and for every seller there has to be a buyer. If the stock or the share price closes at the top of the range. That means the buyers were more aggressive, demand obviously exceeding supply, and the buyers were obviously getting in at a higher at any price, or at a higher price, or more aggressive. The sellers, on the other hand, were only willing to sell at higher prices. So yeah, you can see an uptrend, and obviously that's what we're talking about here. Demand is pushing the price up. If the stock closes at the bottom of the range, okay, like the scenario over here, this is where the sellers were more aggressive and willing to get out at any price. The buyers, on the other hand, obviously were willing only to buy in at lower prices. Okay, so this causes the stock to move down. So what's important to understand is where the stock closes in relation to that high-low range will tell us who's winning this war, okay, between the buyers and sellers. And this is the most important thing to know when reading candlestick charts. So those of you that don't know much about candlesticks, like a majority of you are, I think it's important that we understand the fundamentals. Okay, so the difference between the open, okay, and the close, we call this the real body. So this is some of the terminology we're going into more detail. So we're talking about a real body. It's a difference between the opening price and the closing price. The higher of these values creates what they call the upper extremes, like the bar chart. Okay, we'll have the upper extremes, the high for the day, and obviously the lower extremes will be the lower extremes. Okay, the amount of the stock price that the stock rises, the share price rises above this real body. So obviously that amount there, we call that the upper wick or upper shadow. Okay, and obviously the amount here, but that moves lower than the bottom extremes, we call that the lower shadow. Sometimes they call it shadows, or they refer to as shadows, or I like to call them as wicks. The lower wick on the upper wick, like a candlestick, that'd be the upper wick and the lower wick. But let's stick to shadows. In some charts, obviously, when it's bullish, the prices are rising. We'll have what they call a white body. You'll see my charts. My charts are blue, and if it's a bearish day, where the close is lower than the open, where what I call a dark body or black body, or in my charts you'll see they're red. Okay. By the way, as I mentioned just now, candlesticks can be created for any time period, daily, weekly, monthly, hourly, even those of you that are trading on swordfish, tick by tick and minute by minute. Okay, so what's important to understand is don't just look at these candlesticks by themselves, and we'll go into more detail just now. Don't just judge them in isolation. What's important is to look for the follow-up action. And we always talk about confirmation signals. So you're looking for any signals that follows the applicable period. So the day afterwards or the day before, it's important to look at those things also. So what's our ideal situation? Okay, where do we want to be? Candlesticks, as I mentioned right in the beginning, is one of the most powerful technical analysis tools in a trader's toolkit. Remember, it's like a quiver of arrows. You've got a whole lot of arrows to choose from. I believe this is one of the most important tools to use. They're also the most prevalent. Okay, most technical programs, technical analysis programs, will have them, will include them, and most of them obviously will be set as a default. The Metastock programs, the Omni Traders, the Wen software, all that do have candlesticks. So what's important to understand, and this is where I find it so powerful, candlestick charts give a signal in advance of much other market action. Okay, so it's a leading indicator. We talk about leading indicator of market activity, and you'll see why we talk about it just now. But just understand that there are over 100 individual candlesticks and candlestick patterns. This can be very overwhelming. And so when I first started reading about candlesticks, all the different names and things like that, I felt overwhelmed. But the thing is, don't be daunted by all the information. What's important to understand the psychology behind it and how to apply it. Okay, so the idea is that with experience, obviously there's certain patterns that will be more predictable that help you in predicting and making consistently profitable trading decisions. And those are the ones, if you use them correctly, they should increase the accuracy of your predictions. And obviously that should translate into more profitable trades and ultimately more money. Okay, so how do we get there? So remember, as I mentioned just now, candlestick charts are just a different way of visualizing what is happening on your charts. And obviously what's important to understand is that you want to detach yourself from when I say detach, is by reading it, you'll be able to understand it, so you can read the market sentiment and momentum straight from the charts. So don't get hooked so much in the chart patterns as just reading it straight away from the chart. So yes, we're talking about human emotions, and yes, we're talking about buy and sell signals. But as I said right in the beginning, there's nothing on the chart that matters more than price. Everything else is secondary. So the way I've tried to simplify this process today is to understand these 5 scenarios. Okay, 5 possible scenarios. And I want to highlight this image at the bottom here. Always think of a tug of war between the buyers and the sellers. Who is winning? We talk about buyers and sellers. We talk about the bulls and the bears. Okay, the buyers and the sellers, demand and supply. So there's 5 scenarios. Either we have a strong bullish power, bulls are in control, or number 2, we have strong bearish power, the bears are in control, there's more sellers, or we have a scenario where the bears have tried to push the price down, but the bulls have managed to push back. So imagine this tug of war, this rope going backwards and forwards, but the bulls managed to conquer, so they recover. Or we have a scenario where the bulls try to force the price up, but there's obviously more bears, and the end of the day, they won. In the 5th scenario, we have a bit of a tug of war. We're right in the middle. The bears and the bulls and bears are having equal power. So that little rag right in the middle is not moving either way. So equal power. So that's the 5 possible scenarios we're talking about. To go one step further, we're talking about 5 elements of a candlestick. So we're going to go into more detail. We talk about the size of the body, the length of the wicks, the ratio between the bulls and the bears, the wicks, and the ratio between the body and the wicks. And the 5th scenario, the position of that real body. But as again, I want to highlight for you that tug of war. Okay, so let's look at the first one in more detail. So the size of the body. Okay, so the rule of thumb is that the larger the body, the stronger the signal it provides. That's number 1. And number 2 is the large body indicates that the price has moved a great distance between the opening price and the closing price of that candle. A large body and small wicks indicates great strength. So, here we scenario here, I can quickly highlight my little thing here. That's the opening price to the top there, and that's where we close. So the bears were winning on that particular day. That's where we open, and that's where we close. That's where the bulls were winning. So the larger the body and the smaller the wicks, the greater the strength. So that's number 1, the size of the body is important. Number 2, the length of the wicks. Now, the length of the wicks gives you the direct information about volatility. Okay, remember we see right in the beginning, you as a trader want volatility. The longer candles imply greater volatility. Okay, so longer those the lines are, the better. And we'll go into more detail just now. We talk about wide ranging and narrow ranging candles. A long wick and a body near the bottom end, or near the other end of the candle, shows that momentum has shifted. Okay, so in this scenario here, that's where the market opened. That's where we closed. But intraday, the bulls try to push the price a bit higher. And you can see ultimately we closed here. So in that scenario, the bears are still winning. Same scenario here. That's where we opened. Okay, and that's where we closed. But intraday, so we actually closed. Intraday we went a bit higher. But intraday, the bears try to push the market down, but the bulls won the battle. Okay, so the length of the wicks, as I mentioned in the highlight just now, shows you volatility. First scenario, the ratio between the bulls and the bears, the wicks. Okay, in this scenario, when the price moves up and gets pushed back down, this leaves a long wick. It's very similar to what I said just now. Okay, bullish strength is not enough to keep prices down, and that's obviously where the bears are overcoming the bulls. When the price moves up and gets pushed up, okay, when the price moves up, okay, a long wick to the downside, the bearish trend, we try to push the price down, obviously wasn't enough to keep prices down. And in that scenario, the bulls were winning also. Okay, so what I'm trying to make is just to understand the psychology behind it. It's a little tug of war. Who's winning between the bulls and the bears? So the fourth scenario, the ratio between the body and the wicks. The question you need to ask yourself, is the body large, whereas the wicks are small? In this scenario, yes, they are. Okay, so this shows you that the price has moved from the open to the close without much volatility to either side. Small wicks and a large body are a sign of strength. Long wicks and a small body indicate indecision. In other words, there's equal power between the bulls and bears. That's a tug of war. Imagine the red right in the middle. It's not moving either way. Equal power. So remember, in this scenario, indecision. And we are highlighting some of those examples just now. In the fifth scenario, the position of the body. Does the candle have a long wick to the downside? Is the body at the top, the very top of the candle? This signals obviously greater strength than the body in the middle of the candle. Okay, that's one scenario. Other scenario is, does the candle have a long wick to both sides? And this scenario is what we talk about in the next few slides. It's called a doji. Okay, the body is very small and is usually positioned right in the middle. When you see a doji like a cross, this is a serious indication of indecision, and obviously there's equal power between the bulls and the bears. Okay, so those are the 5 scenarios. What's important to understand, it's 5 times 5. Those are the worst case, and there's 25 different combinations you can get, but those are the 5 basic elements on the candlestick charts. So, what are the benefits of looking at just in 5 ways? Okay, if I had to demystify the chart patterns for you, okay, we've showed you that there's not necessarily, you have to remember all the candlestick formations. What's important to understand is 5 times 5, the elements previously discussed. So you don't have to learn so much about, and this is where a lot of people get hung up on all the different names. I want to highlight for you, it goes further than that. It's price action and just taking your trading to the next level. Understand, if you can understand the psychology behind it, you'll be able to understand it much better. So yes, I've done these webinars before, and at the end of this webinar, we've linked to this webinar with the recording and things like that. And this is what I took it from a website called Swing Trade Stocks. These are the 5 most popular bullish candlestick patterns. Okay, so they usually indicate obviously reversal patterns, and they usually show after a pullback. So you find that the market has dropped, and now we're starting to bounce up. So we talk about bullish engulfing, hammers, arami, piercing, and dojis. I'm not going to go into too much detail now, obviously time constraints, but those are the bullish patterns, and the opposite of that will be the bearish patterns. So this comes after the rally. If the price has gone up, now the market's pulling back. These are the most popular 5 bearish patterns you can look for. Okay, there's an example what I spoke about just now about the dojis. Don't get so much hang up on the names, understand the psychology behind it. Okay, so this is my Metastock program. Those of you that do use Metastock, you got a facility where you can actually use the software to identify certain chart patterns. Now, just to simplify it, as I say, on the Metastock, there's more than 100 different patterns. I've just highlighted engulfing bulls and engulfing bears on the charts. You'll find that sometimes there's a great little rally there. Sometimes it shows you a great little correction, but sometimes it gives you some false signals. And this is why I say it's not the Holy Grail. So it's a tool to help you find those patterns. That's number 1. But also you're using it together with other technical analysis. And in this scenario, I'm using the volume at the bottom of the histogram confirms price action, and especially the spikes. I'm using support and resistance trend lines. There's a support trend line, there's a resistance trend lines. I'm using chart patterns. There's a bit of a rectangle. There's a long-term support trend line. I'm also using moving averages. I've got a 50-day and a 200-day moving average. So don't just ignore the traditional technical indicators too. You build up on that. But I chunked right down to price action. other indicators are secondary. So when I say other indicators, I've got the RSI and I've got the stochastic. Okay. Price action is my my primary indicator. These other indicators are secondary. However, I do use volume also as a confirmation indicator. So Metastock's great in identifying the patterns. Those of you that do use the WEN software, you can go scan different scenarios in your highlighter module. You can use candlestick charts. These are different alerts. I'm looking for bullish engulfing, and I'm only scanning the top 100 shares. And I scanned this yesterday. They came up with 4 little shares that meet that criteria. Bullish engulfing line. What's important is to confirm. So there we go. Bullish engulfing. That was on Mr. Price, Netcare, SAPI, and Sun International. Now, we always talk about high probability trading. So this is bouncing off a 50-day moving average, but the trend is still bullish. That's still bullish. This is bullish, yeah. However, on SAPI, we're trading below these lines. Okay, so just be aware that the probability is that the long-term trend is still down. So could this be a start of a change in trend? I don't know. We need to go above that before I really get excited. Okay, so the other 3 charts would be stronger for me to look at, to dig further. Okay, so you might have a lot of other questions and things like that. I mentioned just now other technical tools. What I find useful, and again, this is a website I came across called Trader HQ. There's 10 things you need to know as a trader. We're talking about different time frames. So you look at a daily chart, switch over to weekly chart, switch over to a monthly chart. You want to look for areas of support and resistance. Okay, you want to use volume, number 2, as a confirmation. Remember, volume is the number of shares traded, confirms price action. And I suggest that you use candlesticks as a default on your charts, and then overlay on top of that your moving averages and save that as a default. But when we talk about major chart patterns, we're not talking about so much Japanese candle formations. We're talking more about triangles and rectangles and head and shoulders, those kind of tools. And that helps us get in and out of certain trading situations. But very important, and I'm firmly believing in using averages, especially a 50-day moving average and a 200-day. The crossover, the 2 of them, what they call the golden cross. Anything above that's bullish. The crossover with the 50-day below a 200-day, so what they call the death cross, it's bearish. So from a probability point of view, it highlights should you be long or should you be short. That's first of all. And then secondly, obviously, a lot of other things looking at measuring your trend strength. I use stochastic and I use RSI. I use MACD a lot. And those of you that know me for a long time, I use an indicator called ADX, which is part of the DMI indicator. It also shows you, are we in a trending market or a trading market? I use line charts, candlestick charts, and you see all just now overlaid with support and resistance levels. Those are horizontal lines. And also shows me where the buyers and sellers are. I also use trend lines. Those are the diagonal trend lines. It's a breakout of those support and resistance levels or trend lines that will trigger entry or exit strategy. And so the strategy I use for trading is what they call breakout trading. It's important also to understand market cycles. Now you can refer to, and I've done webinars in the past, Elliott wave. You can use cycle analysis. And the Metastock program is very powerful in that kind of stuff. And there's a whole lot of Fibonacci studies you can use to help anticipate where the market's going. In Japanese candlesticks, we talk about windows. In normal traditional Western technical analysis, we talk about gaps. So where the price gaps up, there's panic buying, and price gaps down, there's panic selling. So what's important to understand is, will that gap be filled? A lot of times the price will run away. We talk about breakaway gaps and exhaustion gaps. So be mindful of those and the psychology behind that too. And the 10th step is, as I mentioned right in the beginning, I've been using candlesticks for many years, and I'm still learning. I'm listening to an audio book at the moment. I read a book years ago from Douglas. The one in psychology. Mark Douglas. There we go. Mark Douglas, Trading in the Zone. So it's all about the psychology in it. This morning I just listened to the game. Just reinforces what I've been talking about today. So guys, as I say, just go click on this link, goes into more detail. But that's just as some other things you might be considering. So let's see what questions you guys have. Oops. Where's my questions now? Okay. Loud and clear. Hi, loud and clear. Only candlestick. Steve, I'm not 100% sure what you mean by that. Obviously, it's referring to one of my questions I used earlier on. Only candlestick charts. So, guys, what questions do you have? Maybe I've covered all the questions for you. Let me put my webcam back on again so you can see me. Okay. You guys can still hear me? No questions. Benjamin, thank you. Look like I've answered all the questions. Everybody says goodbye, 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 goodbye. Okay. Okay, looks like no questions. Okay, let's move on. Let me put the camera off again. All right, let's make it minimize it over here. Okay. Let's just in conclusion, those 5 possible scenarios. Remember that bull and the bear? As I highlight again, the tug of war, those 5 scenarios, who's winning it, and goes one step further, we get more detail, the 5 elements of that candlestick. Okay, the size of the body, the length of the wicks, the ratio between the bullish and bearish wicks, the 4th scenario, the ratio between the body and the wicks, and lastly, the position of the body. If you understand those 5 scenarios and the combination between all of them, so there are 25, you'll be able to understand any candlestick formation out there. Okay, and more important, obviously, the behavior of the traders behind it and the psychology. Okay, so what are your next actions? Those of you that do not have a trading account of us yet and are still new to trading, I suggest start with shares before moving on to onto CFDs, single stock futures, especially if you want to use leverage. I mentioned just now, obviously, the understanding Japanese candlestick patterns. This is a webinar I did way back in November last year. So you can click on this, it'll take you through to the actual PDF, and that'll take you to the recording. Okay. Upcoming webinars. Next week, we're talking about the 5 retirement myths that can spoil a happy retirement. The week after that, we talk about how family trusts can benefit from investing in endowments. Those of you who are more the investors and are more fundamentally orientated, end of May, we're discussing 5 undervalued stocks we're taking a look at. So I'll be looking at some of the financial ratios that you'd use to identify those stocks. In June, we're talking about retirement savings again. And then we come to the 8th of June, we're talking about currency futures, how to hedge and speculate on the rand. Middle of June, we're talking about how to trade as a swing trader using index futures. And then obviously the end of June, we're talking about how to hedge your share portfolio using single stock futures. Okay. So guys, hopefully from my side, you've benefited from there. There's my email address and there's our contact number. You're welcome to drop me an email if I haven't dropped that quick. Okay, there's a question coming here from Clive. Hang on, question, Clive. Let me get back here quickly. Appreciate the questions. I'll give you guys more time to type up. Okay, where's my questions? Okay, it disappeared. Yeah, it's back. Okay. Stelios pressure. Why candlesticks is better than open, high, low, close? Neil, great question. Why are they better? I just think it's just more visual. You know, if you're just looking at a glance, you can look at all more buyers and sellers. Where if you look at a normal bar chart, you first have to identify where is the opening price, where's the closing price. With a candlestick, just at a glance, you can tell you what it is. What's also important is that relationship between the opening price and the closing price. That real body created by a candlestick also tells you a lot more information than a normal bar chart. So Neil, I hope that answers your question. Stephen, is it better to focus on one candlestick pattern to start with? Yes, and I suggest you do that, especially if you're new to candlesticks. Go look at the bullish engulfing pattern and look at a bearish engulfing pattern. So understand how those work and how often are they reliable. And then go look for a doji, that little cross. Where does it apply? Where does it appear? What happens afterwards? So yes, Steve, to answer your question, I suggest you do that. Great question. Okay, what are the other questions coming through here? All guys are saying goodbye. Thanks. Cheers. No, pleasure. Okay, looks like there's all the questions. Okay. So guys, from my side, I appreciate you being on this webinar. Thanks for participating. Thanks for the questions. Until next week, keep well, and bye for now. All the best. Bye-bye.